Welcome to the Daily Update, where I'll go over the action in the market for Thursday, March 30th, and then we'll see how things look for Friday, March 31st. We had another up day. Most of the gains were seen right at the open, and then we drifted a little bit sideways. We went down a little bit, fell back down to support, and then were able to rebound going back into the close. So things are really improving, but there's one major warning sign that I'm seeing right now, and I'll bring that up here a little bit later in the video. One thing to take care of, please be advised, from April 22nd through May 11th, I will be traveling. I'm going to do the best that I can to post at least the daily videos and possibly the weekly video, intermarket analysis video, and the deep dive video. I've also launched a podcast on YouTube, which is an exact duplicate of this video you're seeing right now, but that may interest some of you. And there is a PDF in the description for the podcast as well as each video of the slides and charts that you can download and look at to follow along as I talk about things. I also have a private Facebook group. I'm trying to make that more active now. I'm putting more posts in there. So please, if you want to join that, all you have to do is send me a request. Those of you that are in the group already, I hope you're enjoying the new posts. And also, I want to apologize for the date mistakes that I made in yesterday's video. I was trying a new way to update things. I got out of my routine and I messed up a whole lot of the dates on the slides. I'll try to be more cognizant of that in the future. Let's go back and talk about what happened right at the open. We had a gap higher open with prices going above R1 at 40.39. They also went above R2 at 40.50. As the day went on, prices then drifted lower to below R1 before climbing back to close at R2. We were up 0.57%, and this is a warning sign and a concern is volume is below average, but our technicals are turning much more positive overall. But in the short and intermediate term, we're starting to become overextended to the upside. We're seeing a lot of indicators getting extreme positive right now. The markets are still really fixated on inflation and interest rates, and Friday will be true as well with a big inflation report coming out. And we're worrying about this whole banking problem. Is there still more to come? Here's the intraday chart showing how we gapped above R1, came all the way up to R2, drifted sideways, then went lower down below R1, but then saw some late day buying and got all the way back up to R2. Here's growth versus value, which didn't perform all that well. Growth did outperform value in the large caps, but they underperformed in the mid caps, and they were actually down more in the small caps. Here's the intraday chart. Most of the gains were seen when the market was closed. We gapped higher, drifted lower, and then were able to get back higher again going into the close, and we're shifting around a little bit in the overnight session thus far. What are some comments that we can make? Volume continues to be below average, and that is a concern. We're going up and up and up on a decrease in volume. We should be seeing a pickup in volume because Friday will be the last trading day of the week, month, and quarter. So you'd expect that to really spike up, but it's just not doing that. On a short-term basis, we have our Stochc RSI, stochastics, and now the Williams %R is added to the list. Intermediate term, we have the McClellan Oscillator, the PMO study, as well as the CCI 14 and 20. The dollar declined and interest rates were mixed. Another thing that we need to pay attention to is what's the status of the US dollar. There's been some information in the news talking about how Saudi Arabia is not going to use the US dollar anymore. Well, then this came out where it says China and Brazil agreed to trade in their own currencies instead of the US dollar. That's a major shift. And if we see that continuing to go on, we want to make note of that because that's important. Everything has been denominated in the US dollar. And if that is starting to change, that could really impact things longer term. We saw that in the British pound. It used to be the British pound was the main currency and English was the main language. Well, when America replaced England, the US dollar became a lot more important and English was still spoken throughout most of the world. But things can change over time, so we want to pay attention to that. The Home Builders ETF is flashing a major negative divergence, and I made this post in the Facebook group as well as other places. This is one thing we just really want to watch. So if you're watching anything for Friday, you want to keep an eye on the Home Builders ETF and how is it acting in relation to the S&P. And I'll show you the chart later. The 30 to the 5 is still normal as far as its yield curve, but all of our other yield curves remain inverted. Sentiment is still negative. It's ticking up. It was at 40. It ticked up to 44. If we go above this, we'll get more into the neutral area. Our trend is still positive with the green line on top, but it is weakening. It's below its moving average. It's also below 20. Our bias, though, is positive, and I've changed our momentum now to positive. The economic reports that came out, we had weekly jobless claims, still pretty strong overall, meaning not very many jobless claims. It came in a little more than expected at 198,000, but still it's dropping below that 200,000 threshold that a lot of people refer to. The third estimate for the fourth quarter GDP came in at 2.6%. It was down a little bit from 2.7 the last time we got this estimate, so that did drop off just a little bit, but the other areas were unchanged. The GDP price deflator came in at 3.9%, which was expected, as was the personal consumption expenditures index. It came in at 3.7%. And the core PCE price index came up a little bit at 4.4%, where it had been 4.3% the last time we got the estimate. Looking at some Isabel Net charts, this is suggesting that the better part of the calendar is here. We're looking at the first quarter in the third year of a presidential term, where it typically has been up. Well, March is pretty much over, and so we can cross that one off. So now we're looking to the second quarter. It typically has a favorable seasonality. This chart I've shown before, and this has been posted and reposted many times. It's suggesting that forward earnings per share estimates are still really high. The consensus is that the earnings per share are going to go up. That's the yellow line. If we look at the Morgan Stanley non-PMI leading earnings indicator, it is still declining overall, and there's a real spread between the two. The yellow line is the actual earnings as they've been coming out, and that has been dropping, which is putting a lot of pressure on stocks. Looking at FANG, I still call it FANG, but they've changed the acronym around, where you have Meta, which is Facebook, Amazon, Apple, Microsoft, and Google. They've been doing pretty well at the time this chart was prepared. They were up 19% overall, where the S&P was up 3%, where you have other companies are pretty much unchanged. This is a historical chart. I won't really go over this. You might want to pause and look some of these things over. Right now, we're just dealing with the idea when we had the COVID lockdowns and the stimulus and the fiscal policy and all the changes that were made, that threw a lot of money into the market. Well, now the Fed has been decreasing their balance sheet because of this banking crisis and the use of the discount window. The Fed balance sheet is really starting to go back up. Is that where some of the strength that we're seeing right now coming from? And now that that's starting to go back down, is that going to put some pressure onto stocks? Another chart that shows wars, pandemics, and banking crises cause world recessions. This is just the different bad things that can happen and the impact that they had on the stock market. Are you more likely to increase or decrease your bond portfolio over the coming days or weeks? 46% say that they will add to their bond exposure. Looking at some banking information, the top chart, the net percent of banks reporting having stronger demand, that is really decreasing as interest rates are going up. And this chart is inverted. I'm not exactly sure why, but it shows the tightening standards going up when in this chart it looks like they're going down. The chart from Bank of America says that investors are now the most bearish that they've been since the start of 2023. We bottomed out right here. We've been coming back up, but this is starting to come back down as we were going through that banking crisis that still may not be over. Another Bank of America chart shows the U.S. shadow banking is still seen as the biggest source of systemic credit events that are happening. And what is the most likely source of a systemic credit event? This chart kind of goes hand in hand with part of the program that I teach. It says that accelerated passive flows are being real resilient as stocks have been coming up. Passive, that means that you get into an index fund like the S&P 500 or the Dow Jones Industrial Average or the Qs or the NASDAQ or what have you, and you just add to that. You're basically watching an index and basing things on that. Where active equities, you're getting in, you're getting out. You might be a short-term trader. You might be a swing trader of some sort. We're seeing that really dropping off as far as the money flowing in for those different types of things going back to 2010. One chart that Tom McClellan posted on Twitter is an interesting chart showing the correlation between the cash assets of all commercial banks. That's the blue line. And as it was going up, the stock market was going up. As it was going down, the stock market was going down. We're we're starting to see a little bit of a breakdown where the assets have been going back up with this banking crisis. Will that give some support to the S&P 500, or are we going to start seeing a breakdown in that overall relationship? Looking at some of our charts, the Ulcer Index continues to fall as the market's going up, showing that we're getting more complacent. The VIX is dropping below 20 and still declining on the line chart as well as the bar chart. The VIX of the VIX shows that volatility has really been decreasing. The equity put call ratio, which could have been giving some support to stocks after we spiked up above 0.8, we've been coming back down. That gave some support to the market so far. Doesn't really look all that much on the chart, but it has been triggering a signal, and this could be a positive backdrop for the market. Looking at another fear gauge, fear is starting to subside based on this chart. We also had the recent reading from the American Association of Individual Investors. They're still pessimistic overall, but this data is a week old, and they tend to react to what's happening instead of seeing things before they happen. Then looking at the high beta stock, are we going risk on, risk off? We're still dropping overall, so we're having more of a tendency to go risk off, even though the market has been doing well this past week. Looking at the condition of our trend, it's trying to turn back up a little bit, but we're still below the moving average. The green line's on top, so we default to positive, but we're still trendless overall because we're below the moving average and we are below 20. The daily chart showing how we were able to get above this pivot level, so that's positive. And we're still above the 50-period moving average. But you can see on the bottom, as we've been going up, volume has really been dropping off. Here's a 2-year look at that same chart, showing how volume has been dropping off. Our Arun really hasn't changed after giving us an extreme negative reading. It's still negative overall, showing that sellers are decreasing, but so are buyers, and it's picking up this less volume that it sees in the market. Our Keltner bands, we're getting above the 1 Keltner band here, the 1 standard deviation. So we're not necessarily hitting an extreme reading with this chart, but we just want to keep an eye on this. The Stochk RSI is still extreme positive, which could suggest good momentum, but at the same time, the fact that we might be getting short-term overextended to the upside. The Williams percent R is now added to the list, being extreme positive. The short-term stochastic is also extreme positive. Intermediate term is starting to go extreme. We're crossing above with our long-term stochastic and looking better. The force index continues to be positive. We're still well above the 20-period simple and exponential moving averages, and we're above the 50-period moving average now. And the 100-period moving average is still below current price. Our moving average tree shows us coming out of all the plotted moving averages and looking a little better. The swollen trading oscillator looking positive right now, but really going up strong and could get extreme positive very soon. All of our oscillators continue to be positive, both short, intermediate, and long term. The parabolic SAR still has the dots underneath. That's positive. The Chaikin oscillator is positive and not extreme yet. The Vortex turned positive a couple of days ago and remains positive. The Ultimate Oscillator actually ticked down a little bit. Not sure why that happened on an up day, but it did decide to do that. The Sean Trend Meter is also looking positive. Our moving averages are doing pretty good with the 20, 50, and 200 and not getting extreme yet. However, the CCI 14 is extreme and the CCI 20 is now extreme positive. The RSI is showing improvement. Both the 14 and the 9 are above 50 and advancing. This is a little bit of a warning sign. We're not seeing stocks breaking out against the utilities, so this ratio has actually been going down slightly. Our Ichimoku cloud, we're back up into the green cloud. We might hit this upper area of resistance, or can we break through and keep going up? The PMO continues to be positive. Our PMO study, we're starting to get extreme positive with the percent of PMOs that are rising. The buy signals are positive, and we're turning back up with the PMOs that are above zero. The BPI is still positive as well. We saw this positive divergence, and we're coming back up out of that. This chart is improving, but it's still negative because we're below 50. It will turn more positive if we can cross above 50. And the NYSE bullish percent index is also showing improvement. The Chaikin money flow actually ticked down a little bit on an up day. Just want to keep an eye on that. But the red line, the moving average, continues to go higher. The balance of power continues to be positive. We're getting a little extreme with the CMB composite index. We're going to the upper band of going up a little too far too fast. TTM squeeze also showing improvement. The go-no-go system still has these brown bars here, so that's more neutral. And we're getting a little further away from the 200-day simple moving average. We want to keep an eye on this anchored moving average going back to the all-time high, which right now is at the 40.73 level. If the market continues to go up, that may offer some overhead resistance. The short-term fib level, we're above these resistance levels, and we still have quite a ways to go to get to this next resistance level. The longer-term fib chart, also quite a ways to go to get to the next resistance level. Longer term, we're above this 40.20 level, and we still have quite a ways to go to hit the next resistance level. Looking at our ratio between the S&P 500 and the equal weight index, it is starting to come down. You can take this chart two ways. When this was going up, that means the big stocks were outperforming the little stocks, which a lot of you want to have happen, and that can be positive. That's where we get our real growth from and the real movements in the indexes. On the other hand, if the smaller stocks and the broader range of stocks are not participating, that could be negative overall for the market. Well, this ratio is starting to come back down after giving us a really strong reading. The Elder Impulse system for the S&P continues to be positive. The McClellan Oscillator is getting extreme positive, but still positive nonetheless. And our broader range McClellan Oscillator is still showing improvement and not extreme yet. The summation index based on price and volume continue to be positive. The new highs, new lows are holding up a lot better with our 5-period and our 10-period moving averages. The advanced decline ratio is looking a lot better based on price. You could call this a negative divergence based on volume. However, we have crossed back above the moving average, so it is showing some improvement. The advanced decline ratio, we have both the blue and the red line above zero and advancing, so that's positive. Accumulation distribution also remains positive. However, volume continues to drop off. Looking at some different charts, the Heiken Ashi now has open candles. That is positive. The Kegi chart has a black bar that's going up. That is positive. The Renko just added a new open box. That is positive. We added a new X to the point and figure chart, even though no signal has been generated. But anytime you add an X, that is positive. The 3-line break also has an open bar. That is positive. The boom indicator is above zero both on the 50 and the 200 period moving averages. So that is turning more positive. Longer term, we're going up with our 150 and 200 and not extreme. The financial sector did experience some weakness in Thursday's session. The bank ETF was down 1.5%. The regional bank ETF was down over 1.5%. The other regional bank ETF was down over 2%. The ratio between the regional banking ETF and the financial sector continues to show a decline. And First Republic, I was going to take this off, but then it declined 4% in Thursday's session. Here's a broader look at the advanced decline line. The top line is what we just got done looking at, and that's turning more positive based on price. We're showing a little bit of improvement with the mid caps. We're right at the moving average, but we're trailing off a little bit based on the small caps. We want to see the small caps regain some strength if that's going to give a lot of support to the S&P. The Dow is above the pivot level for the month, so that is positive, but it's still underneath its own 50-period moving average. The diamonds, however, are positive. The NASDAQ is coming right up to some resistance at about the 12,000 level, and the NASDAQ 100 is breaking out a little bit, so that's showing a lot of improvement. The Qs for the NASDAQ 100 are positive, and we're coming up to this 12,867 level, and we actually closed above that at 12,963. Can we hold above that level and keep going up with the NASDAQ 100? The micro caps were down in Thursday's session. We want to keep an eye on that. They just recently set a new 52-week low. They're not there yet, but we want to watch this index. The small caps were actually down on the day. Here's the Russell 2000 showing the MACD has crossed over positive. The RSI is still below 50 and going sideways. And the Elder Impulse system for the small caps has now switched to a green bar, so that is positive. The ratio between small caps and the S&P, that is really breaking down, and that is a concern. The mid caps, were able to get a little bit above this pivot level, but then close down below it after getting back above their 200-day moving average. The mid-caps still remain positive, though, with the elder impulse system. Here's the big chart. You can see where the S&P 500 has been going up. The home builders have been going up, but not all that much, so the ratio's been breaking down. And look down at the bottom. The correlation is really starting to go in opposite directions. Other times when we saw this often marked a top in the S&P. So we want to just keep an eye on that. If you are able to do so, bring up the home builders ETF and see how it's performing during the day. If it's showing strength or weakness and the market starts hitting a rough spot, that could influence the S&P 500. Or it may be a non-event, but this is something we just want to keep an eye on, because before, when this kind of a thing has happened, that's had a real impact on the market. The Copic curve, though, is still generating a buy signal, as is the Pring bottom fisher. Bonds were little changed based on yield or price in Thursday's session. Our long-term trend looking a little better. The MACD is starting to turn up just a little bit above the moving average. We're still trying to evaluate, was this breakout that happened at the beginning of 2023, was that a real breakout, or are we going to eventually fall back down below this? So far, this is holding up and showing a little improvement. Our possible positive scenarios, we're showing an improvement with the 19-day exponential moving average of the advanced decline ratio, going up nicely based on price as well as volume. The 10-day average of the S&P 500 highs minus the lows are also above 50 and advancing. That's positive. Looking at the broad range of the 5-period moving average of the highs minus the lows, this is still negative but showing some improvement. And then looking at our ratios, the Qs to the S&P are going back up, still seeing some weakness with discretionary, but it was up slightly, and seeing some improvement with large cap growth versus large cap value. Here's another look at the growth value ratios with the large caps showing an improvement, mid caps a little bit, not showing as much improvement, but still positive overall with the small caps. Then we're also keeping an eye on this. This chart is showing a little improvement. You can barely see it, but the red line is ticking back up because the indicator remains above zeros. The longer it stays above zero, the more likely that red line is to turn back up and go positive. Looking at the 2-year Treasury yield after spiking up and coming back down, that could be giving some support to stocks. And then our staples to S&P 500 ratio is starting to go back down. We're wondering, is this going to be a new spike that we can work from? So what's our outlook for Friday? Friday is the last trading day of the week, month, and quarter. The technicals are positive, but there are these warning signs that I tried to refer to. We have personal income coming out on Friday, as well as personal spending, PCE prices, the core PCE. This is the big inflation report that the Fed pays attention to. We also have the Chicago PMI coming out and the final reading for consumer sentiment. And then the whole list of geopolitical events. We're just wondering, is there going to be more banking news that comes out and hits the market, either positive or negative? But the market remains fixated on this inflation and interest rate scenario. We do have 2 speeches being given on Friday, but they will be after the market closes. Then looking at the Stock Traders Almanac for Friday, the Dow is only up 42.9% of the time. The S&P is a little bit better at 47.6% of the time, and the Nasdaq's a little more positive at 57.1%. And then these positive backdrops, that this is the last time I will show these before I update this slide. Here is the chart showing the 23rd trading day of March, where the green line is going down slightly for the last day. We're supposed to be in this positive seasonality, but that really didn't happen this year. Here's another chart showing that we should have been in some positive seasonality. So our scenarios, can't really go with the down one because the technicals are improving, but there are warning signs to be aware of. Volume, the home builders, some of our indicators that are showing improvement but are still negative overall. We can't really go with the up one because we're not trending right now unless you're super aggressive. So we're having a tendency to still go with the sideways trend because the ADX is weakening. It's below 20 and it has switched over positive, so we still default to the positive trend. Our conclusion, the S&P is improving, but there are some warning signs. Now, the market always has warning signs. I'm really concerned about this home builders ETF. I want to see some improvement in Friday's session to take that off the table. And it could go away. It could end up being a non-event. but it also could give us a pretty good sign that the market is getting a little topsy and due for a pullback. In the short term, we're positive, but it's becoming more overbought. The same thing is true with the intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. Some of our long-term indicators are also showing some improvement, and not so long ago, we had a recent golden cross. Thank you. I hope you found this helpful. Congratulations to the Seattle Mariners, who are undefeated this season. They've won their first game. There's only 161 games or so left to go before the playoffs start. I'm sure that they'll be able to win all of them with no problem. But it's good to have baseball up and going again. I'm a big baseball fan. I hope you have a very good day, and I will talk to you in the next video.